Thanks, Adam, and thanks to One for inviting me along for this slot today. It's good to see some people in real life again and some familiar faces. So yeah, I'm James Whiteside. I'm from Wood Mackenzie. I look at things like the strategies of the diversified miners, covering things like benchmarking, how emissions targets are going to be met, how robust payouts are, what basically our combination of asset cost analysis and the market analysis that we do, the price forecast, means for the company's valuation. But today I'm going to focus on something that's hopefully really relevant to this audience, what the strategies of the major miners, the diversified miners, means for the industry as a whole and juniors in particular. And also answer some of the questions that I know are in the agenda. So let's go for it. So Bernard Looney called BP a cash generation machine. And I'd just like to contrast that with the current performance of the diversified miners. And here we're looking at the percentage of operating cash flows going to Capex and cash dividends since 2012. And it's really quite striking the levels of payouts being achieved by these companies. On average, 41% last year. Compare that to 19% from the integrated oil and gas majors. So really, if we're looking for cash generation machines or dividend generation machines, that is these major miners. And, you know, really gone are those early in the last decade days of Capex overruns and impairments, but they really do set the scene for the strategies of the miners that we're seeing today. They're awash with cash, delivering this record free cash flow, dividends, profits, but frankly, they're playing it safe. They're already deleveraged and delivering these capital returns. What this means, though, is that the current levels of high dividends, while they sit well with generalist investors in today's environment, the rate of payouts, in a way, set a bit of a high watermark for which expectations of future dividends will compare. So where does that leave us in terms of Capex to deliver the energy transition? And within the broader capital allocation framework of these mining companies, where does growth Capex sit? So management remains very disciplined on Capex, and we believe this will keep supply growth constraints. We're showing here actual and guided Capex since 2012 going out into 2024. And just to put them into context, the highest number there is $9.5 billion by Rio Tinto in 2024. Our numbers around this are relatively well publicized. We say $200 billion is needed to be spent over the course of the next decade just to deliver the base case needs, which is essentially a 2.5 degree global warming pathway. To get us, to jolt us really onto a 1.5 degree pathway, which is the goal of the Paris Agreement, we need to spend a further $200 billion this decade. Capex increases, they're coming through, but from these companies, at least the majority of the Capex increases are in sustaining Capex, and now additionally decarbonization spend. Rio, big headline number, $7.5 billion. Vale similarly came out with $4 to $6 billion. And all of that leaves less room for growth Capex. Capital preservation is very core to the strategy. These companies don't want to make the same mistakes as the past and to moderate supply growth at the same time. So overall, what we're seeing is this year, 2022, Capex across the industry is at multi-year lows, which is not where you'd expect things to be given the buoyant nature of the market overall. We've seen some acceleration this year. BHP brought Jansen forward. Rio Tinto is committing $3 billion, but hasn't associated that with specific projects. Both of those companies, both of those figures from those companies really show that there is a lack of growth options within these now sort of thinned down companies, and the project hoppers really need to be replenished. So looking where we are now versus where we're going to be in 2030, given our asset analysis of these companies, in most cases, what we see is growth seems to be coming at the expense of diversification. Anglo is probably the exception there, but iron ore is really still dominating. We're showing copper equivalent production by commodity, and essentially iron ore is slightly downplayed in that because we're using our long-term prices to get to that number. But when we look at these figures, and when I look at these figures, what I see is that the mining companies can't really get away from their addiction to iron ore. Does less diversification mean a lower multiple? I haven't seen the evidence of that, but what I can see from this is they must be confident on the outlook for iron ore. Whereas it's our view that prices will trend lower over the next 5 years in anticipation of supply constraints and a moderation of Chinese demand. And prices really need to fall in anticipation of the growth that we're seeing here from the diversified miners. And based on that analysis, we model the cost of these industries. The 95th centile for cash cost for iron ore is around $85 a ton CFR. And we believe that with the expansions that we're seeing here, we're going to need to go well into the cost curve and see prices at $75 a ton. Now, if you don't buy into all that negativity that I've just presented, I think the relative attractiveness of nickel and copper is clear, and it's really central to these companies' strategies in all the material that they're putting out. But most of the brownfield options that these companies have in those commodities are being pushed back, and that's amongst the uncertainty in the established jurisdictions, see Chile and Peru. And recent acquisitions that they've made really come with these multi-year lead times. But just on that point, why do they need growth? Is really to support those dividends that we talked about on the first slide. So is building better than buying? Well, it depends what you're looking for. But if you want near-term growth, you need to understand the lead time of the asset you're getting into. This slide characterizes the production lead times for projects in these various commodities, how long it takes to get from your initial resource to full production. And when I speak to the specialists in the market, they tell me, look, you need to break it down into the different technologies, countries, et cetera, et cetera. So we provided a bit of a breakdown here, but really this is a representation of what the average are. When we look at lithium, there's not really much of an inventory of projects to look at. Kautschuri is coming online towards the back end of this year. That had an initial resource estimate in 2012. So what's that? Just over 11 years, 10, 11 years. When it comes to hard rock lithium operations, I guess it's somewhat more variable, but this 4 years is around the range for greenfield projects. And alongside that, you need the conversion capacity, but that is typically lower lead time. When it comes to nickel, I think the ramp-ups have been fairly well publicized in terms of the difficulties, particularly around HPAL operations. But more recently, what we've seen is that the Chinese seem to be having better luck with the second generation of these types of projects. And thinking about the major strategies in relation to this, when we look back, let's be honest, over the last bull market, the miners weren't exempt from overruns. So the point is they need to generate some growth options soon to deliver anything meaningful before the end of this decade. And what you can see here also, I want to emphasize the point on lithium, is that spodumene concentrate production is the lowest of the lead time, and for that matter, execution risk operation. So just on this, there was a point in the agenda posed the question, will we see a correction in some metal prices, or is there room for battery metals to run higher? And we've seen, as you know, metals retreat in recent week from elevated levels, really as fears over Chinese economic health takes precedence. But in most cases, they remain above where they started the year. Last year, there were a series of a combination of factors: pent-up demand, actual economic recovery, restocking, hoarding, green growth. That all supported demand. And while on the supply side, the supply chain risks issues were all obvious to see. And some of that is likely to ease into H2. For the remainder of the year, we expect a small surplus for lithium in battery grade in 2022, but that's based upon projects coming to market on time and on budget. Nickel, we're going to see more units of NPI for stainless and matte for nickel sulfate, and both of those are in Indonesia. The analysts there are keeping close track on these private Chinese companies from afar. Copper, our view is that restocking of concentrate and matte stocks will prevent the surplus while mine supply is growing this year. But there is a real upside risk for commodities. When we look to China, Xi Jinping needs economic growth to get back on track. And that really is a big if, China manages to avoid further lockdowns, we will see large-scale stimulus. Xi's promised to go all out on infrastructure, and the emphasis is more on tech-led infrastructure than property-led infrastructure, as we've seen previously. And all of that sounds extremely metals intensive, but relies on people being let out of their home. So just on this slide that we've had up for a while, the share of supply required to meet our base case scenario, that's associated with that $200 billion number by the end of the decade. That is based upon, when we look at the battery raw materials, we're now at 30% by 2030 penetration. And that's for the 2.5 degree scenario. Understandably, we're at the lower end of the forecast range. So there is additional upside from this. So investments and project approvals basically need to be happening now if electrification isn't going to be constrained by material shortages. And what we've also seen is that with last year's sort of bottlenecks in the automotive supply chain, semiconductors, wiring harnesses, and battery cells themselves, and the paralyzing impact that had on the sector. And we're seeing OEMs move further upstream and thinking about raw materials. The main example recently is VW announcing its intention, taking the leap and investing in nickel and cobalt in Indonesia, which really highlights for assets for the competition for assets that we're seeing for the majors. So here we're showing M&A by company between 2015 and 2020. The bubble size here represents the deal size and the date of announcement. One of the things that really strikes me when I look at this chart is the real hiatus in deals that we saw in 2019. And for me, that really indicates an inflection point in commodity cycles, and it certainly marked a change in the strategies of the majors. The traditional hunt for long life, low cost assets has fallen in priority versus shedding the assets that don't fit that criteria. And that was what we saw in 2015 to 2019. And Glencore and Vale are still on that journey. They're still shedding assets this year. Rio Tinto is somewhat ahead of the games in terms of its pursuit for greater exposure, attempting to buy out Turquoise Hill, and with the acquisition of Rincon. And BHP appears to be targeting the earliest stage of operations in Filo mining, SolGold, great examples, as well as the failed Noront acquisition. On the right-hand side, the net positions, it won't surprise you that Glencore has been the net buyer over this time, mopping up the others' thermal coal assets, boosting its production and its carbon footprint at the same time. For Glencore now, though, they're really reaping the rewards. Their net debt position is below their $10 billion internal threshold. And at that point, they looked to reduce that cash level. And the last time we saw that happen, they went out and had a host of special dividends and also acquisitions. So they're in a very good position to spend. And that's really across the board. Recent deleveraging plus 2021's record cash flow generation, they have the strong balance sheets to pursue growth. But the new management teams are really taking more of an evolutionary approach. There's a consensus that the reluctance to buy at cycle highs will constrain the scale of transactions. So I'm just going to do a little bit on valuation, see if we can identify any trends in the valuation of junior miners that might indicate where transactions might happen. We're tracking a large portion of the juniors' single commodity plays in copper, lithium, and nickel. And this shows the enterprise value to our valuation of their assets at a 10% discount rate. And there's obviously a lot baked in here. You know, you've got our commodity prices, you've got our start dates. But one would expect project developers to gradually get up to parity with NAV as they get closer to production, realize a greater proportion of the asset value as they essentially de-risk the project. And that's represented by the grey line here. So when we look at individual commodities, how does that line compare in terms of the trend for copper? The copper curve is slightly steeper than expectations, with copper prices about $1 per pound higher than where we expect them to be longer term. Perhaps that's not unexpected. The nickel curve has a gentler slope with more value given to early stage operations. And again, that really highlights the level of competition that we've seen in the nickel market for assets. Acquirers and investors are willing to get in at an early stage for exposure. Lithium valuations, they're frankly all over the place. There's very little risk consistently applied to the development stage of the assets. Highlights the sort of frenzy in the market as it's been labeled by BHP recently. But when you do dig a little bit deeper into the valuations here and you look at the quality of the asset versus its valuation, there is a real premium there for quality. When we look at companies, and I'm highlighting here some countries, that have some interesting issues going on. And the reason I'm doing that is because there is certainly an appetite for the majors to move beyond their traditional jurisdictions. BHP's Kabanga Lithium acquisition or investment, Rio's Rincon Lithium, and, indeed, Anglo's investment here in the UK. The combination that we're seeing of the rising fiscal risk in Chile and Peru has been realized, and the declining asset quality has led valuations to be depressed, and that will not be resolved anytime soon. There's going to be a lot of uncertainty, at least until September, when Chile's constitutional of the vote on the constitution is completed. And when we look to the US, obviously Biden signed his Defense Act, and that has had a positive effect on the valuation of mining companies there. It's going to inject capital, but will it manage to get US assets over the historic obstacle of the social license to operate? So last week, BHP reaffirmed its ambitions in copper and nickel, but at the same time downplaying their intention to stay out of lithium, and really citing that steeper cost curves were what they were looking for. And I do like this metric. It indicates, the ability of a producer in the bottom end of the cost curve can ensure a lower limit to margins if they're operating in that lower half of the industry costs. What's interesting, I think, here as well is the relative homogeneity of the bulks, and that's been the traditional the traditional home for some of these major miners. And we've seen the flight to quality in iron ore and similar in met coal, which has evened this out. But in reality, has that really been borne out in practice? So what could change this? What could alter the course of the industry to actually exacerbate this trend of higher costs in certain industries? Well, here I'm showing the effect of potential carbon taxes. The titles a reference to outgoing Australian PM accused Labor of planning to introduce a sneaky carbon tax. And it is an existing policy that's in place, but the implications of the election for carbon policy, while not certain, it seems likely that Australia's cap and trade system will become more stringent. And the last time there was a Labor government in Australia, we saw the mineral resource rent tax introduced. The Australian Greens look to be the power broker. But across the world, we're seeing an escalation in carbon policy as governments look to reduce their emissions to hit their Paris, now Glasgow, targets. And what we see is, in our analysis, to get us on a 2-degree trajectory to incentivize the levels of decarbonisation in industry, to get us on a 2-degree trajectory, a carbon cost of $110 a tonne is what's required to make those incentives. And the same, if we're going to get on a 1.5 degrees scenario, $150 a tonne. And when we look at the steel industry, actually, the abatement costs are much higher than that. So it might even be that we get to a higher level. And what would be the impact on the competitive position of mining companies operating in some of these extractive industries? Well, you would certainly see a reshuffling of the deck. So it's not consistent that high-cost assets are also high emissions assets. If one, as a major miner, could position at the lower portion of the cost curve, and they could benefit from inflationary pressures of carbon taxes. And it really is inflationary. The industry, it adds cost to the industry. Commodities with high footprints and low costs will see that structural shift in cost related to carbon. And at the same time, what we'll see is that capital is restricted for a portion of the market that's higher emissions. So miners who can develop those assets in the lower portion of costs and emissions will be in a very good position. So put simply, find a commodity impacted by carbon prices and central to the energy transition and help it develop in a sustainable manner. That seems to be the strategy we're going after. But I wouldn't write off lithium. And the point I want to make there is while nickel has been announced as the battery raw material of choice, the fundamentals of lithium are strong with lower risk. Demand substitution is further afield. Supply is less supported by established operators. So there's a natural restriction on some of the ability to get into production. And should lithium prices fall further this year significantly, there will be some heat coming out of the market, and valuations could get to the right place for the majors to enter. And I could have shown here mine life, scale of operations to show they do have that materiality to suit the majors. But I think that point's been well made. And when we look at the assets themselves, we're only scratching the surface with many of the hard rock operations eminently expandable. So at that, I'm going to say thank you very much for your time. And yeah, I think we've got a little bit of time for questions.
Does anyone have a question for James on some of that? James, I'll just throw something out there around hydrogen and looking, further afield, and you're scaling up there. Does Woodmac have a view on sort of the speed with which that's coming, and sort of what some of the majors are doing and positioning into hydrogen technologies, either within their mine operations or indeed going after PGMs, thinking of like Anglo and things like that?
Yeah, no, it's a good point. So we do cover the hydrogen market. We see green hydrogen costs coming down significantly following a similar trajectory to battery costs. They're about $6 per kilogram now, and in the middle of next decade, they should reach $2 per kilogram to $1 a kilogram. And that's the sort of level we need to see for basically hydrogen trucks in the mining industry to become competitive. We did some analysis around Anglo's hydrogen truck. We think it will probably consume, the numbers aren't out there, we think it will probably consume about a ton of hydrogen a day. And when we look at that in terms of fuel costs compared to diesel operations for that scale of operation, that works out to be about $250 a ton, whereas expectations would be around maximum 50 cents a ton just in diesel costs for a diesel operation. So that's just the fuel costs. Then you've got Capac associated with the fleet, the electrolyzer, the renewables. I'm not writing it off, but it's going to be a long way down the road.
Certainly. Excellent. Well, look, unfortunately, that's all we've got time for, but thanks very much, James. Let's have a round of applause for